Right, I think we've got a few in, so we'll kick off. Welcome everyone to the webinar, Financial Times Analytics, Unlocking Alpha with Premium News Intelligence. So today I'll be hosted by RavenPack, where it's myself. So I'm Yannick Marlowe. I'm a senior account executive here at RavenPack, and shortly we'll be joined by Peter Hafez, who's our chief data scientist, to run through a few of the research that him and his team have been doing. Right, so just to start off with the agenda and set the scene. Firstly, I'll go through and I'll tell everyone a little bit about RavenPack, super high level, just make sure that everyone knows who we are and what we do. And that will include a little bit about our product lines. Okay, I'll then pass it over to Peter. Peter will go through why we're working with Financial Times and their content, as well as those aforementioned use cases around stock selection, sector selection, and currency selection. So we will be finishing with a Q&A, but there's a chat at the bottom with the Q&A section. So please, throughout the webinar, please ask any questions. And if we get a chance, we'll get to it at the end. Okay, so just to start off with a little bit about RavenPack. So we've actually been around since 2003, believe it or not, so 22 years, and we're a natural language processing company. Right? In that time, we've built up a repertoire where we work with a whole range of the world's largest asset managers, hedge funds, and banks. And really what we do is we turn huge amounts of unstructured textual data into structured analytics, okay? And there's kind of three main facets to this in terms of what we do. And the first part is coming from what we call our proprietary knowledge graph, okay? And our knowledge graph contains more than 12 million entities. And think of this as our way of effectively tagging all of the text when it comes in. So we can tag this with company names, for example. We track 7 million companies, but it could also be people, places, organizations, commodities, currencies, you name it, anything related to business and finance, we will tag that information. And the kind of second step to this is we have a huge event taxonomy, 7,400 events, which allow you to filter for anything to do with, say, company earnings or anything to do with GDP or inflation. And kind of the third step here is around sentiment. And we've provided sentiment around 20 different sentiment scores now, where you can effectively then construct these factors or new sentiment factors, depending on what it is that you're looking at. And these can be used as a direct input to a systematic trading model. Okay, so just to kind of move into a bit more detail on our product lines, right? So today we'll mainly be focusing on what we call RavenPack Edge. Okay, and RavenPack Edge there's a few different parts within this, and I'll go through that in a second, but just more for information as well. We also have bigdata.com. This is our more AI-ready product. It's for building financial agents and agentic workflows, chatbots, all of these different types of things. So, it's always something that we can talk about in the future, but today we'll be focusing on Edge. And just to kind of go one level deeper, I'm going to start in the middle here because there's three main lines to RavenPack Edge. And in the middle, we have analytics. And this is turning all of this textual data into, think about it like tables, rows and columns, where you can filter for those company names, you can filter for events, you can filter for sentiment. And we have a long history within RavenPack Analytics, going about 20 years, that effectively allow you to construct these kind of factors based on anything thematic that you want to do, based on all of our pre-constructed sentiment scores. And you can build something bespoke using this analytics product. And I'll show you a more specific example of this in a second. But I just want to go one step back, right? And I want to talk about annotations. This is, say, the level below RavenPack Analytics, right? It's the raw text in JSON format with a normalized schema. So this is effectively what we use to build up analytics. And it's a huge data set with all of our tags, our full history, and it allows it to be stored on your end. And it's a data set for all of your data science needs, right? And I'll go into detail on that in a second as well. And just so you know, we also have factors. These are more pre-constructed sentiment factors where we've taken our granular analytics scores, we've kind of averaged them out and structured them and smoothed them into some factors that make it really easy for you to ingest this type of data into your models, right? So I talked about these examples. I just want to go through and show you like a little snapshot of what analytics would look like. So here you can see a table. It's just a subset. We actually have 82 fields in total. But here you can see some of the main things that we look at and that you can use within RavenPack Analytics. So everything from a timestamp through to a document ID for traceability back to the original source. And in this example, we've actually used, the entity is UK, so a country. We've got things like relevant scores. So we can effectively tell you where in that document the UK has been mentioned. This is actually a 20, which is quite low, but it doesn't necessarily matter in this example. You can also see some of the events that we've got here. We've got a GDP guidance event. It's quite granular, as you can see. It's not just GDP, it's GDP guidance. And we've also got a composite sentiment score there. And this is like an individual record, right? Coming from the text that you see on the right-hand side, but it's a snippet, right? It's a simplified version of what we're actually doing as a company to the full textual document. So that actually takes me on to RavenPack annotations, right? And I can show you a quick example here. Again, this is just a little subset, but this is the schema that I spoke about before. It's a JSON database that includes embeddings. It includes all of our tags that we have for entities, for events, for sentiment. And we have a 20-year history here. So if you're looking for something much more granular where you say, I want to build out my own relevance scores, I want to build out my own sentiment, and for that I need the raw text. But effectively what we're then doing is we're taking away all of the difficulty in terms of tagging the content, in terms of enriching that content. It becomes a huge enriched database for you to build any strategy you want from scratch. Okay, I think that's enough from me to begin with. So I'd love to pass it over to Peter to go into a bit more detail on FT and our partnership there and some of the research that he's been doing.
Thank you, Yannick. Hello, everybody. So at RavenPack, we track more than 40,000 different types of news sources. And this ranges from anything from Dow Jones to Wall Street Journal to Barron's to empty newswires, and of course also broader web content. We, as part of our research, we refer to that as core news. And of course, one of those questions that you might ask is, with all of this news content, why would you look at Financial Times as well? And I will say that, first of all, as part of our research, we have found that the FT actually carries relatively modest correlation, or the signals that we create actually carries relatively low rank correlation with core news. And it's low enough to be additive, but still high enough to be correlated with the same underlying market realities. And it's also very clear from our research that the market does appreciate the premium and high quality journalism that is being brought to market by the Financial Times. It's clear that it has financial materiality. It's not necessarily a massive data set, but it's more about fewer higher conviction events. And it provides a very good use case for creating more amplification type signals on top of other news signals that you create. If we look at the general coverage, we can see that there is a tilt towards more macro, and we are seeing a 60-40 split between macro and company data. But we see that while you have this tilt, that it can cater for many different use cases across multiple asset classes. And I will cover 3 different use cases as part of the study today. What's also interesting with the Financial Times dataset is that you have a quite rich history. So the dataset goes back to January 2005. So you have about 20 years of data, which is in line with our other premium data sets that we have with the core news feeds. So let's take a look at some of the research that we have done. Well, as mentioned, we have tested more recently 3 different distinct use cases across 3 different asset classes for the Financial Times. And here's basically what we found. So if we look at use case number 1, that's probably the most simple of the 3 strategies. It's an equity stock selection strategy. And we're building standalone signals for both core news and for the Financial Times. We are looking across earnings-related news events for core news, so anything related to earnings guidance, revenues, dividends. But we're also looking at what might be driving future earnings. So we are looking into patterns, facility open, close, this type of news that is also about innovation and more about capacity as well. For the Financial Times, since it is a smaller data set, we try to go as wide as possible to increase the cross-section. So here we're using all of the news that may happen around companies. And from these 2 individual signals, We do a daily aggregation. We look at headlines. We look at novel content in order to create as impactful a signal as possible. We then, after this daily smoothing, we apply exponential smoothing as well before we combine the two data sets together in a sum-based way. When it comes to the portfolio construction, we create simple long-short portfolios that are dollar neutral. We apply daily rebalancing, and we allocate according to the sign of the signal as well as the magnitude. So we go more extreme on more extreme sentiment names. We do apply a maximum allocation constraint in order to ensure that there is also a high degree of diversification across your basket. And we apply that to the US top 1,000 companies, so focusing on mid and large cap companies. If we look at the performance, first of all, if we look at core news, if we start with the information ratios, we can see that we are able to generate information ratios in the range of 0.40 to 0.59, depending on the decay that we apply to the signal. We're also seeing, if we look at the Financial Times in isolation on a standalone basis, that the highest information ratio is achieved for no decay, or it's basically a simple aggregation with 100% turnover on a daily basis. Here we're able to achieve an information ratio of 0.67. However, we can see that this signal is decaying relatively quickly. So as we start to smooth the Financial Times signals, the decay is quite significant. That said, when you go to the bottom of this table, you can see that when you combine core news with the FT, using FT more as an amplification signal, we're able to not only carry forward the portfolio size of core news, which is significantly larger than the FT signal on a standalone basis, but we're also able to see that we can carry forward some value add from the FT. As I mentioned, as an amplification signal. We're actually able to move to from 0.59 with a 1-day time decay for core news to a 0.75 for the combined signal. And what we see is that we are basically carrying forward the same effective holding periods of 1.5 days. We have similar annualized returns, but we're able to add 120 basis points on top of the core news signal when we use the FT as well as a signal. If we move to and look at this from a cumulative return perspective, it's also very clear here that the Financial Times addition, so to core news, so we're looking at the yellow line, generally performs at a higher level than just looking at core news on its own. But as the table also highlighted in the previous slide, we can see that the most value add comes when you apply the signal on faster moving strategies. While we're able to outperform 1 week out from a holding period perspective, the value add does get smaller. Moving to the second use case, we're actually moving from a faster signal to a much slower signal. So this is a strategy that works with quarterly rebalancing. We are coming up with a sector rotation strategy where we are aggregating also daily stock level signals. So we build sector sentiment from the bottom up. And we actually apply a similar type of filter from an event perspective. So we look at this earnings growth concept where we take anything related to earnings, revenues, dividends, as well as asset-related news within our taxonomy. So that would cover patents and facilities open and close. And it's sort of the same kind of argument that we are looking at not just earnings guidance, but also what might drive future earnings. And again, we create a sector rotation signal for core news. So we like to refer to this as our flagship sector rankings. It's a strategy or a signal that we have covered in some of our previous research. So there's a white paper available here. And then we do a similar signal for the Financial Times, building it in a similar way, so momentum-based ranking for high conviction sorting. In creating the combined strategy, we use a voting mechanism. So we basically apply a strict intersection-based ensemble, emphasizing sectors with strong agreement across both rankings. So if you rank high in both core news and you rank high in FT, that combined ranking ensures that you get selected within your combined strategy. And as I mentioned before, we apply a quarterly rebalancing and we select the top N sectors in a long-only strategy here. So that could be top 1, top 2, top 3, and so on to achieve our final strategy. So if we start here looking at on the right-hand side and looking at the annualized returns, it's very clear that the greatest return you get when you select very, very targeted sectors with the Financial Times, which is represented here in the orange colored bars. But we also see that it decays relatively quickly. But if we look at the green bar where we combine both core news and the FT, we can see that we are able to improve the signal going beyond just a single sector selection and go for 2 sectors, 3 sectors, and so on. If we focus on the information ratio and on the top figure, we see that we maximize the information ratio with a 2-sector selection, but again, you can apply more diversification if you wish. Turning to the table on this slide, we can start off with the benchmark. So we are basically looking at the US top 500 companies as a benchmark. We equally weight the sectors for this particular benchmark, and we can see that that selection would have generated over the backtesting period an information ratio of 0.72 with a 12.7% annualized return. If we look at the core news plus FT, and we select the 2 sectors, we are able to increase the information ratio to 0.87 and adding 400 basis points of outperformance relative to the benchmark. If we compare that to core news, we can see that the improvement is perhaps more modest. We go from 0.83 to 0.87, and we are adding about 60 basis points on an annual basis. If we look at it from a cumulative return perspective, however, I'd like to highlight that if we focus perhaps on the right-hand side here, you have the excess returns to the benchmark. The left-hand side is just a pure cumulative return. But on the right-hand side, we see that in terms of excess returns, at the top, we have the full history. At the bottom, we are zooming in on the last few years since late 2022. And it's very clear that the Financial Times is adding, while it's adding value across the entire period, in the green line on top, you can see it's quite smooth in terms of excess returns. We can see that there has been a significant value add in more recent years, which makes the Financial Times very attractive as an additional signal on top of this sector rotation strategy. If we look at it more from a robustness perspective, I think there are also some very interesting insights. If we look at this top 2 sector selection, we can actually see that we are adding value to the strategy by the dynamic selection that you get from the sentiment scores. In fact, if you compare this top 2 sector selection, we see that this selection outperforms every 2 sector buy and hold combination that you can create across all of the 55 possible pairs. So that's of course happening because we are able to be more dynamic. And if we look at the right side of this slide, you can see which sectors we select. It's not surprising, of course, that we are selecting technology companies on a quite frequent basis, but we have been moving in and out. And over the backtesting period, you can see that we have had at some point some exposure to all of the different sectors, or one of any of the sectors across the history. And I think what's also interesting is that as we moved into 2020, so when COVID hit, you could see that it rotated quite early into healthcare. and also into telecommunications, where you would see companies like Meta and Alphabet for this particular sector classification. So moving to the third use case, which is within currency selection, we sort of go from our higher frequency strategy or sort of short horizon strategies and from our longer holding period sector rotation into more of a mid-frequency strategy. And here we look at macro news, and we do that at the company level, at the country level. We are focusing on the G7 developed market currency pairs, all against the US dollar. And we aggregate, as I mentioned, at the currency or country level across macro events, right? So within our taxonomy, we have multiple layers at the topic level. We have business, economy, we have politics, societal and environmental events. And here we are sort of focusing on the macroeconomic layer. Similar to the other studies, we are filtering for headline events, and we are also filtering for novel events, as we generally find that these the events that are covered high up in an article tends to have more impact, more price impact. So we are taking advantage of this also in this signal. So again, we built our signal based on core news. We'd also like to refer that to our flagship currency trend following signal that has also been described in a previous paper. And then we create a similar ranking for the Financial Times, also across macro news, to detect macro trends. We then apply a voting mechanism. So we create an ensemble process to validate the consensus across the sources, reinforcing more extreme signals and minimizing noise using a non-linear softmax filter. And again, we create our long-short baskets, currency baskets with daily rebalancing, going long and short the top 1, 2, 3 currency pairs. And why do we emphasize the extremes more? If we look at the Spearman's rank correlation, on average, we see about 16% correlation between core news and the Financial Times scores, which sort of underscores the strong potential for complementarity between the two sources. But we also see, as we go more into extreme quantiles or percentiles, in fact, here we go all the way to the 99th percentile, we can see that we get a higher correlation, which is strongly statistically significant. So as we see more agreement, more strong agreement between the rankings, we also see that portfolio returns generally are stronger. And we want to take advantage of that. So moving to the portfolio statistics, we start at the top on the right-hand side, or in fact, the middle part. We're looking at the information ratio. And I think it's very clear to see that you do benefit from not just selecting a single currency, but get a little bit more diversification, both in the long and in the short basket. We see the best performance in going long, short, top and bottom 3. What we're also seeing here, and here I'm looking more at the sort of light green bar, that's where you have the combined signal. And what you see here is that you should smooth the signal a little further to get maximum performance. And in fact, we find that applying a 14-day or 2-week decay is the optimal filter that both optimizes information ratio as well as annualized returns. And if we move to the performance table, we can see that for core news, if we apply a 2-week time decay, we're able to achieve information ratios of 0.48 with annualized returns of 1.6%. Of course, this is an area where you can apply leverage, and we have effective holding periods of around 8 days. If we include the Financial Times on top, we're actually able to improve the information ratio from the 0.48 to 0.81. So a quite significant improvement. And we are adding 108 basis points on top of the performance, reaching more than 2.6% in return. So it's a quite significant boost that you get on the strategy side of things here. And if we look at it from a cumulative performance perspective, again, it's very clear that the green line here, that is the combined strategy, it outperforms throughout the back test, the core news, and also the individual FT strategies. And we also see that outperformance increases as you move to slower moving signals here. And in fact, if you go to the 8-day holding period, so where you have the K14, we see a spread between a long and the short basket of the 260 basis point that I also highlighted in the previous slide. So why should you be buying the FT? Well, FT can make your signal stronger. And we showed that across 3 different use cases of different speeds. So we had a faster moving equity stock selection strategy where we were able to improve the information ratio from 0.59 to 0.75 with a 2-day effective holding period. We showed it also for a slower moving quarterly rebalanced strategy for equity sector selection, where you were able to move from or improve the information ratio from 0.83 to 0.87. But more importantly, we have seen that the improvement has been quite significant over the last few years. And finally, we showed it sort of in a mid-frequency currency trend following strategy, where we were able to improve the information ratios from 0.48 to an impressive 0.81 with an 8-day effective holding period. So why does this work? Well, it works because the Financial Times carries a relatively modest rank correlation with core news of less than 20% across the various strategies, indicating a largely complementary signal. So it's not just a duplication of coverage, it's actually adding some new orthogonal information that you can take advantage of. And what it means to you, if you are an existing RavenPack client of our core news, well, you can easily take the Financial Times dataset and enhance your existing signals without having to invest a lot in any sort of rebuild. The dataset basically looks and feels like what you're used to with RavenPack Analytics. While we have used RavenPack Analytics or Financial Times Analytics here to test the different strategies or create the different signals, you can also replicate these studies from the more raw annotations products. But the added benefit here, of course, is that you get a much more granular set of data that allow you to create your own proprietary features and basically just gives you maximum flexibility, maximum empowerment. So with that said, I will hand over to Yannick, who will say a few words before we open up for Q&A.
Awesome. Thank you for that, Peter. Really interesting research that we've got going on with the FT content. So just to kick off, we'll go through to the Q&A section in a second, and I can see some questions coming in, which is great. So I'm going to start off here with a question here. So it's saying about, could you please repeat what is used as core news? Right. So I can take this one to begin with. So really what we're referring to as core news is the 40,000 or so different sources that Peter mentioned at the start. So this includes both publicly available information and some premium behind paywall content. So we're referring to this as the kind of core package. And as Peter's mentioned with some of the research, how ft.com content can really like implement and enhance that signal. Okay, so I'm just going to put that in and hopefully that answers your question. Amazing. I'm just going to go through a couple of others. So I've got one here about where can we find the 3 associated white papers. I guess I'll take this as well, and then we can get some over to Peter in a second. So these are all available on what we call RavenPack Labs. So any of you that are existing clients of RavenPack will have access to this already, and you'll be able to go into RavenPack Labs and download the papers straight from there. Anyone who's not, feel free to reach out to us afterwards and we can send you the papers and of course discuss how you can get your own login to the papers.
I'll also add here that the currency strategy paper is completely new to market. It's actually the first time that we present the research today, basically, and we will follow up after the webinar to give you access or early access to the paper on Thursday. So that will become available with a link to you. But the other two papers you can access, either reach out to your sales or account executive, or go to labs.
Perfect. Got another question here, and I'm going to test Peter here a little bit. So we've got a question here saying about, could you please comment on when your equity stock selection signal is available? i.e. is it before market open or before market closes? And how have we measured the daily returns? For example, close to close or open to close, like how are we generally thinking about this?
Yeah, so the feed itself is a real-time feed. So in principle, you can cut the signal whenever you want, whether that is before the open or before the close, or at different regions and so on, if you start to trade on a more global scale. But in this particular case, for our research, we typically cut our signals 30 minutes before market close, assuming you can trade the close. And then the return itself is standard close-to-close returns.
Awesome. Great. I've actually just got an interesting one here. So Nancy actually just saying about, will we share the slides presented today? Absolutely. The slides and the recording will be shared with everyone that's signed up to the webinar today. So absolutely, yes. Let me go through another one here from George. So we're talking here about, is the offering more for high frequency solutions like daily or weekly, or, like you showed with some of the other strategies, can they be implemented in slower moving signals?
Yeah, I would say, if you look at our analytics products, it's really a set of granular building blocks that you can use to create whatever signal you want. And of course, some signals that you can create will be faster moving, so moving from intraday into multi-day, multi-week horizons. But as I've shown as part of the presentation, it's also possible to create strategies that are much slower moving. The sector rotation is an area we have had a lot of success on slower moving signals. We have also been building other types of signals that are more related to innovation, also at a stock level, actually, on a global scale. It works across US, Europe, and Asia, but that also works with quarterly rebalancing frequencies. So it's sort of like, it really comes down to how you decide to construct your signals, but also how you may decide to combine, let's say, RavenPack data with other types of data sets that you might have. Will you use it as an overlay to a momentum factor, a value factor, and so on? And by doing that, you should typically inherit the turnover of the baseline signal.
Great. We've got some more flooding in, so I'm just trying to go through the list. But just an interesting one here for you, Peter, from Santiago. So how do we deal with the interplay between markets and news? Which do we see drives which? And his opinion is, I see news like an impulse response function due to attention spans. How do you think about this two-way relationship? And when the momentum charge changes, starts, ends, what's the general relationship there?
It's a good question, and I really think it's both. It is really an interrelations, because you can have news that is being generated because of the market movements and so on, but at the same time, news itself will also drive markets. And of course, the challenge is always trying to isolate the two. And there can also be interplay between news itself. So for instance, if we look at analyst ratings as a classic example, if you look at analyst ratings outside of earnings seasons, you won't have a significant drift going into an analyst ratings change. But if you see it, let's say, during earnings season, well, you see a lot of analysts that reacts to other information, so you might see a drift going into it. I think also, if you want to isolate or sort of look at this interplay between markets and news, you can of course start to filter generally the taxonomy. to see which ones are generally considered more reactive versus which ones are more likely to be novel market-moving events. At the same time, I think it's also not a problem that there is this interaction effect. And I think that that was also highlighted a little bit in the question, that there is this concept of attention, right? And attention in itself, even though prices move, attention can still validate the movement or create a continuation, right? So it's not always about being there before prices move. Sometimes it's also understanding how long will the signal drift in or continue in a certain direction. One example would be, for instance, that if you look at overnight gap returns, right? So you see a big price move overnight, you would typically see a reversal in the following trading session. But if the overnight move has been validated by news, you are actually more likely to see a continuation. At least in the short term, news tends to be a continuation signal. So if you label on a certain price move with saying, yes, there was news to confirm it, you can continue betting on a continuation, and actually by doing so, filter your reversal signal as well and make that stronger also. So there are different ways of trying to model your features and create your signals to sort of consider this overall interaction effect.
Perfect. We've got another question, and by the way, please keep sending in questions. We'll answer as many as we can over the next few minutes. So we've got a question here. So it's really about how to integrate Edge with AI agents, right? This could be one that potentially track multiple AI trading strategies using bigdata.com, which I know we haven't gone into in great detail today, but it's something that could potentially be done. And then two, can ingest Edge metrics for stronger or weaker buy-sell signals, right? And then kind of the third part to this question, Peter, is how do we choose the best strategy from multiple different models? Okay, like how do you see that from like your research with Edge versus big data?
Yeah, I'm sure I will need to have a reminder of the last question before we go through the first ones. I think, I mean, big data is super empowering, and it's probably the more natural data set to start off with when you start to go into agentic, just because. And I say that with a little caveat here, because when you go into agentic, it's also very much about bringing things in front of humans, but you still have agents working in the background. But a lot of use cases, at least, are still where there might be some human consumption at the end. And with big data, you have this hosted infrastructure or hosted data set infrastructure with search and retrieval systems on top. So you can start to build your agents and just call search as a tool and get access to all of the various enriched content that we have. And then it helps you write narratives on the fly. We have been building out sort of agentic workflows where you where it's possible to spin up let's say risk factors, a theme on the fly. So now, of course, we've seen a lot of tension in the Middle East. So you're saying what companies in my portfolio has exposure to the Middle East? That might be a data set that will be hard to come by, but you can basically create it on the fly with the use of large language models and being powered by big data, grounding your answers and structuring or labeling content on the fly with an LLM. That said, I think also you can also with benefit integrate edge analytics into agentic frameworks where you say, look, I can definitely call the API and do function calling, right? Because that's ultimately what it is. If you interact with the API, you can do a sort of function calling and pull structured content, looking at trends, abnormalities, spikes, and those could be a more efficient way of creating real-time alerts or triggers and saying, I see a spike of information. Why is this company commenting a lot about this company? Or why do I see a spike for US? Or I see more news around, I don't know, political news or civil unrest or whatever it might be as a trigger. And then you can sort of trigger big data to then start writing narratives around it, right? So I think there's some very interesting interactions between the structured edge analytics data products and the big data products for more narrative writing. Of course, you could do something similar with edge annotations, but that requires that you invest in your own infrastructure for search and so on.
Awesome. Right, I'm just going to do one more because I know we're getting close to time. So we have here from Richard, how exactly did you address and eliminate look-ahead bias in your data preparation, labeling, training, and backtesting pipeline when using FT News articles to generate signals?
So first of all, what we do with our analytics themselves, we have a version-controlled NLP platform, which uses a step-forward approach. We have a point-in-time sensitive knowledge graph and all of these things. So we represent the data and entities and so on as it was at that point in time. Of course, our analytics themselves have gone through different innovation cycles. And that's why we version control, because it's always this trade-off between how do I test the latest and greatest models, but I also want to have history for it. So what we do instead with our products, we version control them. And then we ensure strong backwards compatibility between versions. So we have taken one of these versions. So the Edge version was launched as a NLP platform. I think it's about five years ago now, and we have applied that algorithm on the FT content with millisecond timestamps, right? That we get as part of the feed. When it comes to, so that ensures that this is what we would really be able to produce with that algorithm at that point in time. And then, of course, it comes down to how do you create your signals. And here, of course, the research that we do is primarily for inspirational purposes. It's really up to our clients to follow the methodologies that they see fit. We tend to apply very, let's say, basic standard filters. We like to use our domain expertise around the data itself in order to prevent overfitting, as an example. So we know that our analytics have certain characteristics. So we have our famous 90-90 filter. So that's something we always start with. We always start with saying we know that having researched this type of data for many years, that headlines matter, novel content matter, and it's also just intuitive. So we would always start with a benchmark like that as a starting point, because it has validation as an expert. And then we would sort of look at it from a step forward basis. You can then start to decide on how do you relax filters to get more volume. It's always a trade-off between signal strength and signal volume. And then, of course, there are also other ways where it would be sort of more specific to the strategies. How do you combine the signals? There are obviously different ways of doing that. We try not to make a recommendation. Because of course, if we start to select certain parameters, there is, of course, a potential of overfitting. We decide not to make a selection. We give you a range and saying this is the behavior of the signal as you start to relax certain filters. And then we let the user decide on the robustness of the signal, if it's something they're comfortable with. And then you end up building your own strategies, your own testing with your backtesting methodology in place.
Great. And we're at time. I know there's a couple more questions, so apologies if we didn't get to it. Just so you know, we'll send the full recording along with the Q&A and the slides to everyone here. And if you're interested in following up on some more questions privately, then please do reach out to myself or Peter. And the marketing team will also send over a link so you can book a meeting directly with us. Thank you everyone for attending. It's been a pleasure, and I look forward to hearing from you.
Thank you all. Cheers.